Hello, I'm Bernard Hickey from interest.co.nz and welcome to another double shot interview. And this is where I buy a CEO or a finance minister or someone a couple of cups of coffee, a double shot coffee, and we have a chat about the economy, business, finance, whatever it is. And today I'm here with Barry Odes. He's the head of CMC Markets for Australia and New Zealand. Welcome, Barry.
Thank you very much.
Can you tell us how people can use CMC markets to trade on not just New Zealand markets, Australian markets, but global markets?
Yeah, well, it's obviously a very popular service that we offer. We offer predominantly CFDs. In Australia, we offer shares as well, which we're looking to do here. And clients can access all range of markets, whether it's foreign exchange, indices, commodities are quite topical at the moment, and also Australian and international shares, all online from our platform.
What's a CFD?
A CFD is a contract for difference, and basically what it is you take out a contract with us on an underlying security, and the CFD, the contract, moves in parallel with the security, and when you close out your position, whether you start off long or short, the difference is paid to you or paid to us, hence the words contracts for difference.
And who can get involved trading using these CFDs?
Anyone can get involved in trading. There are obviously different levels of experience of customers that we have, and we have offerings for customers of all types, whether it's sort of novice clients who are coming to trading for the first time versus intermediate, and then obviously for experienced traders.
And what sort of things do people trade in Australia and in New Zealand?
It depends on the markets and what's happening out there globally. At the moment, commodities are quite hot. Gold, obviously, is at a record high at the moment, so there's a lot of trading in gold and oil. But in New Zealand, 95% plus of our clients' trades are on foreign exchange, and the biggest currency pair that clients trade here is the euro-dollar, euro-US. In Australia, slightly different. We have around half of our trades are foreign exchange. We have a lot of indice trading. The Aussie 200 is a very popular index. And then sort of share CFDs on individual shares come only around 10% of our transactions are in that sphere.
And Euro-US is a pretty hot pair at the moment. What's going on there in the background driving the prices around?
Well, obviously the situation in Europe is evolving at the moment. I think the markets were pleasantly surprised when the rescue package came out, if you like, the $900 billion package. I think that was a little bit more than was expected, but I think since then, scratching below the surface, investors are a little bit sceptical and looking for ways of how that's going to progress and how we're going to get out of the situation in Europe. So it's still evolving. I don't think it's over yet, but I guess the positive thing is that the banks are putting a lot of their weight and thought behind the problem, as they did through the GFC, and managed to steer us through that.
Now, there's a lot of action on global markets every night. We go from currencies to the stock exchanges, the bond markets. How do people trade those markets from somewhere like New Zealand using a CFD? Let's say I wanted to take a bet on where Greek bonds were going. Is that something that you could or would want to do?
You can. Bonds are not highly traded through us. I think there's plenty of activity going on in the international foreign currency. You can take a position on, as we mentioned, Euro-US, and basically, obviously, our system has the live pricing, and once you've opened up an account and you've deposited some money as margin, then you simply click away from taking a position, whether it's either going long or going short, depending on what your view is. So it's very easy to trade.
And what are the risks for people involved in trading these sorts of currencies? Because I can imagine if you're a regular investor, you're doing it perhaps in your spare time, you're up against seasoned professionals, highly paid people with all sorts of money at their disposal. How do you make sure that you don't get hit over the head?
Well, I guess it depends on your style of investing. If you are investing short term or intraday, then you need to pay attention and you need to watch it closely. And let's, taking a step back, trading at foreign exchange is not for everybody, particularly leveraged foreign exchange. You need to have a trading plan. You need to understand what you're doing and the risks involved. So it's certainly not a product for everybody. But again, if you're a long-term investor and you believe that a currency is moving in a particular direction, you can buy the currency and take a position that's not as leveraged as you need necessarily take for a short-term trader, and you can sit on that. We have clients who trade positions for months, for years, in fact, not necessarily only short-term trading.
But isn't there some holding costs, if you like, trying to trade using CFDs for longer periods? It really only suits getting in and out in the short term, doesn't it?
There is a holding cost, but it's not too onerous, a holding cost, when you compare it to borrowing money to do the same through a bank or through margin lending for equity. So it is a very cost-effective way of trading and of holding a position.
Now, just looking ahead, we've got the European debt crisis still rumbling on, fears about the euro, and, of course, the fiscal problems all around the world. Do you think that the volatility in the market, the ways to trade the market, will increase as we see it go over the next couple of years?
It's interesting. I think we're going to be in a period of change. I think we saw prior to 2 weeks ago, volatility had dropped to a level that we hadn't seen in many years. It was very, very low, where markets were just trending slowly upwards and there wasn't a lot of volatility at all, which measured through the volatility index, the VIX. But that obviously, once the European crisis came out, spiked quite significantly. And volatility for us and for our clients is a positive thing. Volatility creates opportunity for clients to trade, whether it's again long or short, and our active trading clients are looking for opportunities to trade again long or short. So volatility for them is a very positive thing. But I think we're going to find that things are going to ebb and flow between investors feeling confident about things and then investors getting a little bit more worried when certain news comes out. So we're in for a bit of a volatile ride, I'd say.
Now, when that volatility strikes, some people ask the question, who is the middleman owned by, and can they stump up with the money if something goes right or wrong? We obviously had the collapse of Lehman Brothers in 2008. Who is CMC Markets? Who's behind you? How strong are you?
CMC Markets is a company owned, around 84% of our company is owned by a gentleman by the name of Peter Cruddas, and he started the company in 1989, I think it was, with £10,000. He's now known as one of the richest people in the City of London. Goldman Sachs are a 10% shareholder. They bought 10% of the company for £140 million in 2007. So they're a sort of a big part of our company, if you like, and we talk to them often and get advice from them often in relation to running risk. But we've been around for a long time. We've got significant credentials in New Zealand alone. We turn over around $1 billion a week in foreign currency, and some of our biggest clients, in fact, in ANZ and globally, in fact, are from New Zealand. We obviously were around throughout the whole global financial crisis. We've come out the other end, as have many other companies, and we're in a good position. We're doing well, and we're pretty strong.
And who are your clients here in New Zealand? I mean, are they mums and dads trading on the side, or are they people trying to hedge their bets for their businesses, or what?
It's a mixture. Again, we have some mum and dads who do trade on the side. We have a number of professional traders who trade quite regularly. There was one trader who traded, I think, last week almost 1,000 times in a week. And then we have other companies who use our services to hedge their physical currency position. So it ranges, and that's the beauty of the product CFDs. It is very flexible. It can be used for a whole wide range of trading, whether it's short-term trading, whether it's hedging positions, whether it's hedging your share market portfolio. So it's used in a number of ways, very flexible.
Some people will trade what they call the fundamentals, looking at which way the economies are going and taking a position there, and others trade using the technicals, looking at the patterns in the charts. Is there a split in who does the most of what? Yeah,
certainly short-term traders trade a lot on the technical analysis, and we have a lot of education around technical analysis as well. It's very, very popular. But there are others who trade the fundamental. Those who are looking to hold a position for longer generally tend to mix the two, fundamental and technical. But certainly the short-term traders focus mostly on technical analysis.
Well, there we have it. Barry, thank you very much.
Thank you very much.
Barry Odes from CMC Markets, Australia and New Zealand. They're talking about global markets and how you can trade them. I'm Bernard Hickey for interest.co.nz, and that was another double shot interview.